Alex walked into a dealership planning to buy a $36,000 car. Less than 2 hours later, he was considering one priced at $48,000. $12,000 more should have ended the conversation. But it didn't, because the more expensive car appeared to cost only $44 more per month. Same down payment, same interest rate, almost the same monthly bill. So where did the other $11,956 go? It didn't disappear, it was pushed into the future. Alex initially asks the right question. What is the price of the car? But the conversation slowly shifts. How much does he want to put down? What payment feels comfortable? Could he manage $700 a month? None of these questions is automatically improper. Monthly affordability matters. But once the negotiation revolves around one monthly number, several other numbers can move behind it. The loan can become longer. The amount financed can increase. Optional products can be added. The interest rate can change. The payment stays near Alex's comfort zone, while the total cost quietly expands around it. Here is Alex's original option. The car costs $36,000. He places $4,000 down and finances the remaining $32,000. At an illustrative 9% APR over 60 months, his payment is approximately $664 per month. Across 5 years, his loan payments total approximately $39,856. Add the down payment, and the car cost him around $43,856 before taxes, registration, insurance, maintenance, or optional products. The payment is not the full price. It is simply one slice of the full price. Then, Alex sits in the premium model, better seats, more space, a larger screen, a quieter cabin. It cost Aben $12,000 more than he intended to spend. But instead of comparing $48,000 with $36,000, the financing comparison changes one important variable. The new loan lasts 84 months instead of 60, 7 years instead of 5. With the same $4,000 down payment and the same illustrative 9% APR, Alex finances $44,000. His estimated payment becomes approximately $708. To Alex, the decision now appears to be between $664 and $708. The $12,000 upgrade has been psychologically transformed into only $44 more. Now look at the complete comparison. The premium car's 84 payments total approximately $59,465. Add the $4,000 down payment, and the total reaches approximately $63,465. That includes roughly $15,465 in interest, almost twice the interest on the original loan. Option A costs approximately $43,856. Option B costs approximately $63,465. The difference is not $44. It is approximately $19,609 and 2 additional years of payments. Extending the term did not make the expensive car cheaper. It made the expense quieter. The effect works because people budget monthly, rent is monthly, salaries arrive monthly, subscriptions are monthly, a $48,000 price active for question. Thus, immediate affordability dominates a cost spread across 7 years. It also creates anchoring. Once Alex declares that $700 feels manageable, the negotiation can become an exercise in fitting a vehicle into that number, not determining whether the vehicle represents good value. Affordability is necessary, but affordability alone does not tell you the cost. A longer loan creates another risk: negative equity. Cars generally lose value over time. Loan balances also decline, but during a long loan, especially with a small down payment, the balance may fall more slowly than the vehicle's value. Alex could reach a moment when the car is worth $30,000, but he still owes $35,000. He is $5,000 underwater. If he wants to trade the car, that $5,000 difference does not evaporate. He may need to pay it or roll it into the next loan. Then he is not only financing his next car, he is still financing part of the car he no longer owns. The $30,000 value and $35,000 balance are conceptual examples, not projections from the earlier loan. Then come optional products. An extended service contract, wheel protection, paint protection, credit insurance, or other dealership add-ons. Some may provide value in particular circumstances. Others may not be worth their cost. But when an add-on is financed, its price can be reframed as another small monthly increase. A product costing $2,000 does not sound small. Spread across 84 months, its principal alone appears to add less than $24 per month, before accounting for interest. The question should not be only, how much does this add monthly? Ask, what is the cash price? Is it optional? How much interest will I pay on it? Can I buy comparable coverage elsewhere? And what exactly does it exclude? To avoid the monthly payment trap, compare 6 numbers before signing anything. First, the out-the-door price, including taxes and required fees. Second, your down payment and the value of any trade-in. Third, the total amount financed. Fourth, the APR, not merely the interest rate. Fifth, the number of months. And sixth, the total of payments. Get financing quotes from a bank, credit union, or other lender before visiting the dealership. A pre-approval gives you a real offer to compare with dealer-arranged financing. Negotiate the vehicle price separately from the financing. Ask for every optional product to be listed individually. Confirm that the final contract matches the agreement you believe you made. And instead of asking, can you get this below $700, ask, what is the out-the-door price, the APR, the amount financed, the term, and the total of payments? That question makes the complete deal visible. The monthly payment is not fake, it is simply incomplete. Alex's 2 options were separated by only $44 per month, but by nearly $20,000 in total cost. A longer loan can be useful when it is chosen deliberately and understood completely. The danger begins when time is presented as though it were a discount. Never negotiate only against your monthly limit. When someone asks, what payment are you looking for? Know your answer. But ask for the other 5 numbers too, because the most expensive number in a car deal may be the one that looks comfortably small. Subscribe to The Hidden Cost. Next, we'll reveal how rolling an old car loan into a new one can leave you paying for a vehicle you no longer own. This video provides general educational information, not individualized financial advice. Loan availability, rates, taxes, fees, and contract terms vary.